Good morning, everybody. We had about 70 people in the waiting room already. Welcome, welcome. This is the typical webinar question. Where are you calling from? Put it in the chat. Maybe what you had for breakfast, what number cup of coffee you're on, or tea or juice. I'm based in San Francisco. First cup of coffee still, so bear with me. Linda, welcome from Phoenix. Thank you for joining. Hi, Olga. No coffee, good for you. It's if you can get past not drinking coffee in the morning, big time kudos. Hi, Jessica from Florida. 2 cups of coffee now on water. Healthy choice. Welcome, welcome. Almost lunchtime for Jerry. Stoked for you all to be here. Well, you are all joining because you might have an interest in learning more about S Corps and specifically tax savings opportunities. And so whether you're on the East Coast or West Coast, we'll get our day going with some tax talk. So feel free to keep engagement in the chat. We always welcome that. If you've got specific questions, there is time dedicated at the end for a live Q&A. There is a Q&A feature within Zoom. So please direct your questions there, and we will make sure that if questions are posted in the chat, we remind you to move them to the Q&A section so that we make sure things don't get missed. But we're going to go through a brief agenda real quick and get through the presentation part so that we can leave time for questions at the end. Arizona with a bagel. Lynn, that sounds delicious. There will be a recording sent after, and these sessions also get uploaded to YouTube. Welcome, welcome. All right, we're going to dive in. So today we've got an agenda surrounding how S Corps can help lower your tax bill potentially. What is a retroactive S Corp election? So you may hear about late filing, retroactive backdating. We'll uncover what that terminology means and how or if it applies to you. Who can make a late S Corp election, how it might impact estimated tax payments you've already made through the year. We'll do a short touch on how Collective makes all of this easy. We're here specifically for solopreneurs wanting to elect the S Corp status. And then we'll open it up for Q&A. So excited to meet with this group. I'm sure there's a ton of great questions. There are no questions too small. So please, as they come up when we're going through the presentation, put them in the Q&A. Quick disclaimer, this webinar is for educational purposes only. And I'll let y'all read the rest and leave this up for a second. And we're gonna move on. So how an S Corp can lower your tax bill. Let's start with some foundational pieces first. The way you get to S Corp status, it's kind of in 3 phases. It starts with a sole proprietorship, which means nothing's formed, an LLC or legal structure, so single member LLC, maybe you have a stock corporation, that's the legal entity underneath, and then you add this S Corp election tax status. So that's what this slide is covering. How do you get an S Corp to be formed? So 1, you need to form a legal structure. So here on the left are a couple legal structures that you could form. This is formed at the state level. Typically, we see people form in their resident state. You might hear buzz about Delaware, Wyoming, and if anyone's got a question about that, drop it in the Q&A, we can discuss. But legal entities formed at the state level with Secretary of State. It's what gives you a legal business name, a tax ID, it creates a layer of liability protection, and it sets the foundation to add what's next, this S Corp election tax status. So your legal entity structure could be one of these 3 listed here, LLC, stock corporation, or if you've got a professional license, a PLLC. And then tax status is how you're reporting your taxes to the IRS. And so there's kind of a couple buckets you might fall in. One tax status is sole proprietorship. which means, whether you're formed as nothing, so truly sole proprietor, or if you have a single member LLC. When your tax status is a sole proprietor, it means all your business activity gets reported on your personal tax return on that Schedule C. What this is called technically is a disregarded entity, which means you and your business are one taxable unit to the IRS. So sole proprietorship, there's some advantages to that. We can touch on that. If you have a legal foundation set up first, it opens the door to add the S Corp election tax status. So you actually exist as both a legal entity with an S Corp tax status. And so for the meat, why does this matter? It impacts your tax bill. Your tax status is what impacts your tax bill. And so we're going to cover the type of taxes that may be impacting you. The first one is unfortunately unavoidable if you've got taxable income. All of us here on this call, if we're United States tax-paying citizens, are going to pay income tax. So income tax is determined by your filing status. So this could be single, married filing, joint, separate, head of household. And then it's factored based on your total household income. So maybe you've got a salaried role in conjunction with your self-employed income. Maybe your partner's got a salaried role on a rental property. And so all of this is what gets factored into determining your income tax rate, and then ultimately your income tax liability. So that's one piece. The next piece is where there's opportunity with S Corp. So when you're self-employed and you're taxed as a sole proprietor, so this is when everything's on your personal return, you pay self-employment tax on your entire business profit. And so the self-employment tax, it's 15%, made up of two buckets of tax. We've got Medicare, which is 2.9%. Social Security is the bulk, 12.4%. And so combined, we've got potentially 3 layers of tax assessed on the entirety of your income if you're paying taxes as a sole proprietor. Federal income tax, state level income tax, and then this layer of self-employment tax. So that said, where's the opportunity with S Corp? What does it let you do? We're going to walk through an example. This is kind of a meaty slide, so I may switch back and forth between the example and this. But what changes within S Corp? When you're an S Corp, instead of your entire business profit being subject to that 15% self-employment tax, the S Corp election requires that you pay yourself out a salary. And this is run through a formal payroll process. And then only that salary, instead of your entire profit, is subject to self-employment tax. So what's it doing? It's carving out a smaller portion to pay self-employment tax on. So no self-employment tax on remaining S Corp profits. It's only assessed on your salary. What else changes when you elect S Corp status? The hats you wear change more formally, at least on paper. You're now both the business owner and an employee of that business. When you pay yourself a salary, you'll still pay Social Security and Medicare tax on that wage, but then that becomes a deduction in part for the business. Again, the slide's kind of reiterating how the savings work. Only your salary is subject to the Social Security and Medicare. And then the bummer, the unavoidable truth, you still pay income tax on everything, salary and profit under the S Corp. It's just, again, a smaller portion is now subject to self-employment tax instead of all of it. Quick pause before I go to the example. There's a couple really great questions in the chat. If you can move them over to the Q&A, just so they don't get lost. Malik and Laura, those are great questions. If you don't mind just moving them over, and we can touch those at the end. So an example, here on the left is someone who's set up as either a sole proprietor, so nothing's formed, or a single member LLC. Again, the reason they're in the same column is because they're taxed the same. In both instances, these individuals put their business activity on their personal tax return. So this is that disregarded entity structure. So here on the left, this business owner has earned $160,000 of profit. Some terminology to debunk we get these questions a lot. Revenue is what you bill your clients. So straight up money in is revenue. Then you've got write-offs, deductions, business expenses, those all mean the same thing. Those offset revenue. So you deduct them from revenue, and what's left over is profit. Profit is important because that's what you're ultimately taxed on. So anytime we're looking at, questions like how much profit, Laura's question, do you need to be an S Corp? We're looking at the amount after deductions because that's what the tax is assessed on. Okay, so business profit of 160. Under the single member LLC sole proprietor structure, that entire 160 of profit is subject to 15% self-employment tax, which is yielding this almost $25,000 self-employment tax bill alone. On the right, the same person elected S Corp, they've got the same 160 of business profit, but under this structure, they're required to pay themselves a reasonable salary. And so in this example, it's 60,000. And now only this 60 rather than the 160 is subject to the 15% self-employment tax. So what does this mean? There's $15,000 in self-employment tax that this person just doesn't pay when they're following the S Corp compliance under the S Corp tax election. Now, a question we get often on this slide is what happens to this leftover 100,000? So in both instances, the 160 in entirety is yours as the business owner to spend for anything you need personally, regular income, mortgage, rent, vacations. That's your money, that's leftover business profit. The way you receive it when you switch to S Corp is now just in two buckets. When you're a sole proprietor, you kind of just take money out. Maybe it's in a separate business bank account, maybe it's not, but you can just take it and spend it. With an S Corp, it's a little bit more formal. So it's going to come to you in two buckets. One is going to be like a formal salary running through a payroll processor. Maybe it's on a 2-week cadence, monthly cadence, and it's kind of just running in the background. The remaining 100,000 you take out as an owner distribution. So similar to how when you're a sole proprietor, you just take money out. It's fully within your control. Like you can facilitate distributions. The amount doesn't matter, does not need to be consistent. It can be at any time. The asterisk we put here is you've got to keep running your expenses through that business bank account. So you don't want to drain it when you take a distribution. The TLDR of this is between the two, your wage and your distribution, you still have this entire 160 of cash flow. You're just now receiving it in two buckets so that you can control the self-employment tax. There's some great questions coming in and we will make sure we get to them. So thank you and keep them coming. Okay, so this whole concept of retroactive S Corp election, late relief, it comes from the question, is it too late for me in, what are we, almost July, in the end of June to capture tax savings with an S Corp? And so this is what this section is going to talk about. Before we get there, I'm going to reiterate a point from the beginning. What needs to be true for you to even be eligible to make a late or retroactive S Corp election? You need a legal entity first. So in the first slide, we talked about legal entities, LLC, PLLC, stock corporations, maybe you have a professional corporation. A legal structure needs to be formed first, and that's the foundation to add the S Corp election. So for this whole concept of late relief or retroactive S Corp status, you need to have a legal structure in place first. If you're a sole proprietor, so nothing's formed, the earliest you can get an S Corp election is the date your LLC is effective. So we're just going to preface there. This will apply if you have an LLC or some kind of other legal entity set up first. Okay, so what is a retroactive S Corp election? It can be referred to as retroactive or retro S, backdating an S Corp election, late S Corp elections. There's a lot of lingo. What it's called more formally with the IRS is an election following late relief. And the other terminology is just kind of lingo that floats around to mean the same thing, capturing the S Corp advantage for a period that's already passed the IRS due date. So what's the purpose? It allows an eligible business, so a legal entity, and there's some other conditions, to elect S Corp status for a date that's already passed beyond the original S Corp election deadline. And we have a slide on that. Why would somebody do this? to capture tax savings. I think that's a bit on the nose, but there's a huge advantage or opportunity to potentially reducing your tax bill here. Okay, so this concept of late relief, it implies that there's something to be done timely. And so what does that mean? If you were to Google, or maybe you have already, like, when was my S Corp election due by, you probably found this March 15th deadline for 2025. So the IRS rule is that you need, in order for an S Corp election to be considered timely, it needs to be made 2.5 months from the desired effective date. So if you wanted your S Corp effective January 1st, 2025, this would get you to that March 15th deadline that you might have researched. Any elections made after that would be following late relief. And so that's kind of like, okay, what are these two buckets? What's timely versus late? If you, I know the term late is triggering, or missing a deadline is triggering, especially when it comes to the IRS. If it's any consolation, there is a solution. So, just to validate, it's not too late if you have an LLC already. There's still time. Even further, the IRS will allow you to capture late relief within 3 years of the desired effective date. Now, there are some implications and costs to consider with whether or not that's a good idea or an advantageous move. But overall, you have 3 years. So pros and cons of late relief with a retroactive S Corp election. The obvious pro, you have an opportunity to capture this advantage after a timely deadline. The bigger one is you still potentially have time to reduce your self-employment tax for this year. What comes with an S Corp election is more comprehensive bookkeeping. You need formal payroll. Everything gets reported on a separate business tax return. So everything's kind of leveled up in terms of compliance and paperwork, which can be a con. But the advantage is it starts to establish a clearer financial story. So let's say, like, your 5-year growth plan is to get a small business loan or apply for grants. Having this S Corp in place comes with maintaining financial statements, which can be hugely valuable if you're looking at growth goals. The cons, again, we just touched on this. What's required once you add this S Corp election? It needs more comprehensive bookkeeping. So what I mean by that, when you report your taxes on Schedule C, all you need is really like an income statement, summary of your total income, your deductions in different categories, what's left over is profit. You could do that in an Excel spreadsheet. Sometimes it's best to use an accounting tool, but you can get away with a spreadsheet when you're a sole proprietor on Schedule C. When you elect S Corp, this separate business tax return reports both income statement and a balance sheet, which I've done it before. It's not fun to track a balance sheet manually. You can if you're into that, but an accounting software would be required. And typically monthly bookkeeping, where you reconcile the bank data and you categorize everything monthly, is going to maintain those financial statements for you throughout the year. So you've got more comprehensive bookkeeping that's required. You have this reasonable salary requirement, which does trigger the need for a payroll system. At Collective, we use Gusto. It automates pay stubs, puts you on a cadence. There's payroll tax returns that are due every quarter for federal and state that this payroll software will generate and submit, and then filing a new separate tax return. All of this can be time consuming and costly. So definitely something to consider if you're looking to make the switch. So who's eligible? We touched on this. First and foremost, a legal entity needs to be formed first. So if you are a sole proprietor right now, meaning no LLC, no corporation, no PLLC, this necessarily won't apply to you. It doesn't mean you can't have a 2025 S Corp election. It just means if you formed it today, what is it, June 26th, and your state approved the LLC today, your S Corp would be effective June 26, 2025. So it'd be kind of a short year initial period. For late relief, an LLC or a legal structure is already in place, which opens the door for you to make a January 1st S Corp election and have a clean year under the S Corp status. So who's eligible? These are taken directly from the tax form. It's called Form 2553. And they're kind of just reworked so they're not as IRS-y, I guess. But who's eligible? You intended to make the S Corp election and simply just weren't aware of the deadline or the paperwork that needed to be filed. And again, these are very vague. There's a valid reason you missed. Maybe you were relying on a professional or somebody who misguided you. Your S Corp or your business qualifies for S Corp status. So this is what we touched on. It's an eligible entity. The S Corp part of the tax code was built specifically for small business owners. So contrary to like the C Corps, Amazons, Googles of the world that IPO, S Corp limits the type of growth. So it's limited to 100 shareholders, only one class of stock so that it maintains the small business owner profile. So less than 100 shareholders. And then there are some other qualifications. You need to be a permanent resident alien. So it's not available if, on certain visas or if you're not a US citizen. So there are some conditions to consider if you're eligible. And then we did touch on this. You're still within the overall 3-year grace period. So how to file this? It's actually pretty simple. It can sound daunting, but it's the same form to make the election as if you're making it timely. All it is a section at the end that's prompting you to fill out the reasonable cause for late relief. You document it, you sign it with the effective date, the name of your LLC or corporation, and it's relatively simple. So 1, determine eligibility and intent. Do you have an LLC set up already? Was I just not informed of this deadline? Fill out the Form 2553 with all the appropriate sections. Usually you fax it, you can mail it, faxing is faster. And then what happens next? Filing the election's easy. What happens next is getting all the operational pieces in place. So this ensure consistent reporting for the entity and its shareholders. This is making sure all the compliance, the bookkeeping, the payroll, the business tax filing is set up to maintain this S Corp status. And I'm just taking a peek at the chat. We've got 14 great questions. If there are more, keep them coming. How are we doing on time? I think we'll have plenty of time to cover these. So how S Corp status can lower estimated taxes you might have already paid this year. So what's happening in this instance? I'll just clarify because this is a question we get often. S Corp doesn't unlock new deductions. Everything that's deductible for you now continues to be a regular business deduction. What it does let you do is control and reduce the self-employment tax piece only. So I'll just preface, like there's, you can take a home office deduction now and continue to take it as an S Corp. You can write off your health insurance in either instance. So it doesn't change any of that. It's more about controlling the self-employment tax via this reasonable salary. So how does it help with estimated taxes? For high-level context, estimated taxes are prepaying into your tax bill. So when you're a regular employee at another company, every paycheck, you'll see two different things. One are income tax withholdings. That's how you pay into your income tax bill throughout the year. If you withheld too much, you get a refund. If you didn't withhold enough, you might owe. So that's one piece of it that happens in a normal employment instance. You also will see 2 boxes for Social Security and Medicare. And so you're paying into those buckets as a regular employee elsewhere. When you're self-employed, you don't have a means for either of those withholdings. You're just getting lump sum payments, deducting your expenses, and it carries on. So these estimated taxes are how you can prepay into all of those systems. Withholdings are for income tax and Social Security and Medicare buckets. So this is a means to pay into your tax bill throughout the year, and the IRS wants that. So they've got quarterly deadlines. If you miss a payment, you can make it up at the next quarter. We can talk about that if there's questions more in detail. But just some foundational context on estimated tax payments. So what does S Corp do in terms of estimated tax payments? It's potentially reducing your overall self-employment tax burden via this reasonable salary. What does this do? Number two, a reduction in self-employment tax means an overall reduction in your total tax liability. So it means you're required to pay in less throughout the year. And three, so if you've paid in year to date, assuming you're going to be taxed as a sole proprietor and you switch to S Corp status, it can mean that maybe you've overpaid so far. And now you can make adjustments. Maybe it means you skip Q3 and Q4. Maybe it means you pay less in Q3 and Q4. Maybe it means you overpaid in total, and maybe you'll just get a refund when you file your tax return next year. So this can help in terms of estimates. Maybe it's improving cash flow for the rest of the year because you overpaid. And it can result in a cash flow bonus when you file if you've overpaid overall. I see great questions. Saw, if you haven't put that question already in the Q&A, please feel free to move it so I don't miss it. And we're going to pause for a quick poll. If you are interested in booking time with one of our advisors after, quick poll that we'll pull up. There's a little disclaimer. This is a sales conversation. Really, it's about seeing if S Corp objectively could be a good fit for your situation. And then further, if Collective is the right fit. So Collective, we're very niche. We support single member LLCs who want to be taxed as S Corps. Certain industries are a little bit more sophisticated in the tax profile. So if you've expressed interest in Collective in the past and for whatever reason weren't able to book, it could be, maybe you're in construction and that's a little bit more sophisticated than, a graphic designer sitting at the computer in terms of a tax profile. So yeah, we want to make sure that Collective is a good fit for you. So if you're interested, we'll give it another second for this poll. Melissa, I see you just posted a question. If you can pull up the Q&A feature in Zoom and just move it over there, I will make sure we get to it. Right on. Okay, so S Corp. The disadvantage is how complicated it can get in terms of the administrative burden. So the idea behind Collective is we're here to support solopreneurs who want to elect S Corp status in taking over the administrative burden. So if you're a sole proprietor and need an LLC, we can form that for you in-house. If you've got an LLC already, we would further file the S Corp election for you. And then we pivot over to all the operational pieces. We have in-house bookkeeping, both a software and an in-house bookkeeping team. So we'll do your books monthly. We'll categorize all your transactions. We'll make sure it matches to your bank and credit card statements. That happens to maintain these financials that are required for that separate business tax return that's due annually now, which Collective will prepare and file that included in the membership. For payroll, we've partnered with a company called Gusto. Maybe you've heard of them. It's fully integrated into your Collective dashboard. It's included in the membership fee so that you can check the box on that reasonable salary requirement. We'll help you with quarterly estimated tax payments. So we'll give you a high-level estimate of what we think you should pay and reminders on your dashboard to make sure you don't forget those deadlines. And then behind the scenes, this is my favorite. You've got a team of people who can support you for questions around your business. So there's no added fees, contrary to maybe like traditional CPA where there's hourly rates. It's all included in your membership. So there's in-app messaging. You can say like, hey, Victoria, who maybe is your MRM, I have a question, like, how does my home office deduction work? You can just, start a conversation, maybe book a Zoom call just like this. And get support for your business throughout your membership. So why would you do this? It's totally doable to DIY it or, bundle together other solutions. With contrary to Collective, you would have to piece together separate, apps, services, fees to get the same bundle of services. And then maybe you're still doing some of the work yourself. So not only do you have a QuickBooks subscription, perhaps maybe you also are paying a freelance bookkeeper, and then you're separately paying for Gusto, and then you're handing off this information to a CPA that you pay separately, which is all totally fine. If you've got a solution that works for you, That's awesome. With collective, it's all under one, one login, one membership fee. It's all housed in one place. So you're not logging into different apps and, asking different providers different questions. So it's a more comprehensive, fluid experience to tackling the S Corp compliance. I'm going to keep this section brief. Our pricing is pretty clear. It's open and available on our website. $349 month to month. We've got a one-time onboarding fee. If you've been to our website, you might see a banner. We're waiving that onboarding fee till the end of the month. And then also at the end, I'll show you this webinar's got a special discount code that ends at the end of the month as well for a free month. So if you're a single member LLC wanting to do this retroactive S Corp election, you might be able to start collective for free. If you're sole proprietor, we would just pass through your LLC formation fee and then, carry you on through the process. Martha, you just posted a question. Oh, I think you moved it. Great. All right. Well, we're here. We're here at the live Q&A. There are 30 questions and we've got about 15 minutes. So we'll get through as many as we can. And if we need to go 5 over, we can do that. I'm going to let us sit at this slide here while we dive through the questions. Scan this QR code. It's also posted in the chat. If you want to book a call with somebody right after, you are welcome to scan the code, enter in a little bit of information about your business, and then write down this promo code. This is what you may be able to use in conjunction with that $199 off. And we're going to dive in. So let's see, I'm going to scroll to the top. FIFO, first in, first out, if anybody's an accountant here and gets that. Laura, how much does your profit need to be for S Corp? So the IRS doesn't have a rule or a threshold for how much you have to make for being an S Corp. It could be a loss, it could be $1 million, it could be 80,000. It doesn't matter for the IRS. What you want to consider if you're going to make the switch, and if savings, tax savings, are the motivator, there's a point at which the savings potential will be more than the cost to do the extra work. And so, Laura, usually we invite people to have this conversation when their profit is over 60,000. And that could be a great threshold to just say, okay, maybe I need to start thinking about my tax status. But I will reiterate, there's no rule with the IRS. It's just if savings are what you're looking for, they may not exist because the compliance is costly if your profit is low. Jessica, if the S Corp has 3 members, do each have to get assigned a salary? This is an LLC. Well, this is frankly beyond the scope of collective. So if you're looking for support, Jessica, for this particular entity, we may not be able to help. But it depends. It depends on the participation of each of the members. And I won't get too much into it, but sometimes people are owners in a business, but they don't participate. This is what's called passive activity. It's beyond my realm of expertise, but it does depend. Typically, you want to see which of these owners is actively participating. So maybe some are just investors, they put capital in, but only one of them is involved in day-to-day operations. And so that's something to consider, and who needs to take a reasonable salary. Usually this is detailed in an operating agreement. Anonymous attendee, can a partnership elect to be taxed as an S Corp? Yes, it can. Maritza, does this apply to professional LLCs operating as an S Corp for tax purposes? Yes. So a PLLC is still a legal structure. It's still considered a legal entity. And so it can still elect S Corp status. It can still do, retroactive or late relief. Collective can also support PLLCs who have already, or any entity, or I shouldn't say that, PLLCs or regular LLCs who have already elected S Corp status are still welcome to collective. We can take over your S Corp compliance and just continue on with the bookkeeping, payroll, or get you on payroll if not already. Short answer is yes, professional LLCs, if you already have one, we can take you to the S Corp status. I thought the self-employment taxes were actually on the net owner's distribution, not on the actual payroll wages. So anonymous attendee is asking how the self-employment taxes are assessed. It depends on how you're being taxed at the moment. So if you're taxed as a sole proprietor, meaning everything's on your personal return, all your pay that you get under that reporting structure is considered an owner distribution because there's no formal salary. And so in that structure, that entire owner distribution is subject to the self-employment tax. When you switch to S Corp, that's when the IRS will allow you to put yourself on salary. And then the self-employment tax is subject to the salary rather than the entire profit. So it's actually, it's on the wage under the S Corp election. Self-employment tax, it can also be referred to as payroll tax. Both those terms are referring to Social Security and Medicare, those same two buckets of taxes. And so under the S Corp, the reasonable salary rather than the distribution is subject to the self-employment tax. Pausing real quick, Garvin, this recording will be sent after via email, and they're also posted on YouTube. So no worries if you missed some of this. All right, on the side with the owner distribution of 100K, I'm not sure I understood. Was the 100K subject to income taxes or not? So let's go back to the example. Great question. So Donald is asking, what happens to this leftover 100,000 under the S Corp structure? So the entire 160 is yours as the business owner, which means it's profit that's going to be subject to both income tax. But in this instance, only the $60,000 wage is subject to both income tax and self-employment. So your entire profit, including this additional 100,000, will always be subject to income tax because it's still income earned within the year. It just represents the portion of your income that now gets to skip self-employment tax. That is a great question. All right, we'll go back to this so folks can schedule. All right, Susan, your accountant just created an LLC and it's taxed as an S Corp. There's currently only one employee on payroll. What is the best way to tax advantage to add myself and our son to payroll? My husband will also be added as he is the owner. I've seen something about creating a management company to run the payroll through. Okay, so this is a question about a couple of things. One, employing family members and holding companies, like a tiered entity structure. Mythbuster edition, it's not always advantageous to create layers. And I'll just asterisk, this is not like legal or tax advice, but generally, if you're running like a small business operation, creating layered structures could just result in more complex filings, like a deeper funnel, which triggers more filings, more fees, more operational costs to land in the same place. So creating another entity, a management company or holding company, may not necessarily impact the tax bill. In terms of putting yourself, your son or your children, spouse on payroll, totally acceptable. The IRS allows it. There are some conditions though. If your children are minors, you have to consider local child labor laws. And you want to make sure that you're documenting a legitimate business purpose for their salary, and it should be considered a fair and reasonable wage based on where you are. Other than that, there are no barriers. You can employ your children, you can employ your partner, put them on payroll. They can be, grouped into the health insurance benefits that you provide to yourself and your family. But consider, are you making sure that you're documenting the business purpose, their roles, maybe there's titles that you need to document, hours spent, time spent, how you arrived at their wage. Kind of just like a CYA, you want to make sure that you're covering all the bases and considering what the IRS might look at. I would make sure to continue to consult with your accountant, Susan, to make sure you're checking those boxes. But in terms of, is it allowed? Yes. Anonymous attendee, we can amend tax returns only for the past 3 years. Is that only as far back as we can elect S Corp? Will doing that for the past 3 years trigger an audit? Okay, so this is a question about the IRS allowing you to go back 3 years to elect S Corp status. And I did mention there are some things to consider on whether or not that's a good idea. the first question is, what are you looking to achieve if you go back 3 years? Is it because this could unlock a dollar amount of tax savings? What do you have to consider? How much could you save by doing this? What's it going to cost me to get caught up on compliance? So if you want to go back 3 years, you have to consider you'll need to file 3 years of S Corp election, 3 years of S Corp tax returns, which means you might need financial statements. So if your books are in a box in the closet, what kind of work, time, effort, cost is going to be associated with rebuilding profit and loss and balance sheets for each of those years? The reasonable salary requirement would still apply. So if payroll wasn't run, what do you need to do to get payroll set up? There's employer registrations involved, past due payroll tax returns involved for each of the years. And then the amendments that you're mentioning. So an S Corp is what's considered a pass-through business. So if you're filing on Schedule C, your business activity gets reported on your personal return. That's also considered pass-through. With an S Corp, it's still pass-through, but you're filing a separate business tax return. It's essentially informational in some pieces. It's going to generate your W-2 that shows your salary and another form called a K-1, which shows your remaining business profit. Once that S Corp election or S Corp tax return is filed, you'll take those two tax forms and include them in your personal return. And so this is what's creating this pass-through. You don't pay tax at the federal level when you file the S Corp return. Instead, the income ultimately gets reported on your personal tax return. Whoever owns it, it'll get included on the owner's personal return. So what's happening here? Now, if you filed your personal return for the last 3 years where you're backdating an S Corp election, you have to now amend those 3 years of returns to include, the W-2 and the K-1 and make those adjustments on your tax personal returns. So the IRS allows it. Consider the costs and the amount of work involved. Oftentimes, maybe it's simpler and easiest to just go back to the current tax year. Is there a 3-year window to elect S Corp election, but I wasn't on payroll, will I be penalized? So again, this is a question on if I go back 3 years, what happens with the payroll? It is a requirement. So running an S Corp and taking distributions, meaning you're using that business profit for personal fund or for personal expenses, you take a distribution without a reasonable salary. In the eyes of the IRS, it looks like tax avoidance because you're entirely skipping Social Security and Medicare. And so running an S Corp without payroll and taking money out as a distribution can be a huge red flag to the IRS. So it's something to consider. Do you have a plan or a process in place to get payroll documented and then all the related payroll compliance if you go back 3 years? So what's the penalty? What's the risk if you have an S Corp, you're taking money out of it and you don't pay yourself a reasonable salary? The risk is that one, the IRS can flag it. They can decide, well, they will decide they don't like it if you're not taking any at all. Then they'll assess a salary for you and then assess payroll tax or self-employment tax on that salary. You'll owe that plus penalties and interest. So that's the risk. And so, sometimes a lot of this, what's your risk aversion? I want to set a salary super low. I don't want to run one, which is not a good idea. Consider the risk when you're making your decision for going back, the risk and the costs. Lindsay's asking, does having an S Corp help with acquiring personal loans being self-employed? This is a great question. And her follow-up as it's establishing a clear financial history. So this is not a proven concept, but we've heard it. It can be difficult to prove or show proof of income when you're self-employed. Maybe some lenders don't weigh self-employment income the same way they do as if you had a W-2 and a pay stub. That may not be true in all instances, but we've heard it enough. And so what an S Corp can let you do is it makes you more formal on paper. Not only will you start getting pay stubs within a W-2, you're also going to get that K-1 I mentioned that shows the remaining business profit. So you may be able to go to a lender and now say, here's my W-2 and my K-1 that shows my combined business income. For whatever reason, this looks more formal on paper to a lender. And so it can help with creating that earned income or formal business history in terms of lending. Let's see, Robert, if you go back 3 years, can you get a refund for those prior 3 years? Yeah, that would be the instance where it's advantageous. If you find an opportunity and are able to get the compliance taken care of, you've considered the costs and you're cool with it, maybe you DIY it and you're really good at that. Yeah, it can result in a refund. Jessica's asking if there's no profit yet, do I still need to pay the salaries? Business started in February for the LLC. So if you're still an LLC, meaning you have not elected S Corp status, you don't take a formal salary. If your LLC did elect S Corp status and it's not profitable and you're not taking money out, meaning you're not taking any owner distribution, it would be okay to not run a salary. And that's because in this instance, in the eyes of the IRS, you're not taking money out and skipping the Social Security and Medicare tax. But if you have not elected S Corp status and you're just a single member LLC, there's no formal salary requirement. You don't need to run payroll for yourself. Oh my gosh, it's 10:46. We're gonna stay on. If you want to stay on, we can go over. We've got more questions and they keep coming in. I think I can stay 9 more minutes. So if you're cool with hanging on, I'll be here. The recording will be posted to YouTube. You'll also get an email sent after if you want to continue watching the Q&A, but gotta hop. So Angela, if I just started making, you're just starting out and making only 5,000 to 10,000 per year, is S Corp still an option or worth the work? Okay, so great question. One of the thresholds for or a couple of the thresholds to determine if you should elect S Corp status is profit threshold is where you consider, can I save more than the extra work costs? And so that line is around 60,000. It's not an IRS rule. That's kind of just a collective benchmark where what you could save could be more than collective's cost or membership fee. Second is the longevity of being self-employed. So once you elect this S Corp status, you're triggering some annual compliance. And so you don't want to go this route if you're like, I've got a one-time contract and then I'm done. You're committed to self-employment, you've got growth goals, you've proven the concept, you like contract work. And so between profit, savings opportunity, and longevity of being self-employed, those are the factors to consider. So Angela, if you're making around 10,000 per year, you could operate as a sole proprietor, meaning you don't have anything formed. Maybe you're still in the like, am I figuring out if I like this phase? That's totally okay. Maybe you've proven that you liked it, but you're still in your full-time role, so don't have the time to grow it right now, but you plan to. Maybe it's worth setting up an LLC now, and you can start, functioning a little bit more formal on paper. The advantage to this is having the LLC in place opens the door for the S Corp election. So, let's say August hits and something changes and you just take off. The LLC existing will allow you to potentially go backwards and elect S Corp status for this year. Susie's asking, so after the 3-year time period, you can't apply for the S Corp. Based on my understanding, that is the grace period. There could be some nuance, but based on my understanding, it's you can go back 3 years. Haley's asking, so if I haven't formed an LLC already, then there is no opportunity for retroactive S Corp benefits. Haley, that's correct. Because an LLC or a legal structure needs to be in place to add the S Corp election on top. So Haley, if you were to form an LLC today, maybe the state takes 7 business days to process. Your LLC could be effective July 1st, and that would be the earliest you can elect S Corp status. If we don't take any distributions from the LLC, no wages, all income is reinvested, working for free for the LLC, is there still risk for self-employment tax? Please review what we're missing. Please review what we're missing out on if not doing. Okay, so this person's asking if you're not taking money out, you're not paying wages, and you're reinvesting. So let me ask, or let's clarify, what does it mean to reinvest? If you're reinvesting in business expenses, so related to the business that's earning income, if by reinvesting you mean I'm putting money into marketing or R&D for this particular business, those are considered business deductions, which means you're reducing your taxable profit. If after you've reinvested in that business activity and it's still yielding a profit, even if it's little, you'll have self-employment tax on that profit. If you mean reinvesting, like maybe you've got a software development company, but reinvesting means I'm putting it into real estate, that's a separate business activity. And so what's really happening in that instance is that reinvestment, that cash is business profit that you're essentially taking out as a distribution to use for a personal separate investment. It's not related to that particular business activity. So in that instance, that distribution is business profit that would be subject to self-employment tax. So I would clarify what you mean by reinvested. Is it putting money back into that same business activity? If so, then you're reducing that taxable profit, which means reducing self-employment tax. If it means you're investing in something else not related to that business, that would be a distribution, personal money, or money taken out of the business to use personally to put into an investment elsewhere. How do you determine reasonable salary? I'm surprised it took a couple of questions to get to this. Thank you for asking. So reasonable salary, it's very arbitrary. The tax code literally says it just needs to be reasonable. So what does that mean? It means that you have to determine your salary for yourself. I'm so sorry, I just spaced out. How do you determine a reasonable salary? The IRS doesn't have a formula. If you were to do some research, you might come across something called a 60-40 rule, where it's an allocation, 60% salary, 40% distribution. Great rule of thumb. It's not a formula vetted by the IRS. So what can you do? I would say comparable salaries are a great place to start. Where do you live? What's your title? How experienced are you in this particular role? Are you spending 20 hours a week versus 40? And you start building this profile of what something similar would look like elsewhere. And then you want to document it. The thing with salary is you're looking for an annual target based on your business activity, time commitment, seniority in the role. And we know that things can change throughout the year. So maybe your plans were 5 contracts, but it ended up being 3. You can make adjustments to your salary throughout the year. So you're aiming for an end goal. How you get there in between matters much less. There's flexibility in payroll. You can set a cadence and then skip one if needed. You can run an off-cycle bonus if you took on a big contract that bumped your business activity up substantially. But determining it overall, it's pretty arbitrary. And so comparable salary, there are some companies, there's one called RC Reports that can do a super in-depth study if that's something you're interested in, just documenting how you arrived and then making adjustments annually, just like you would if you were getting a raise elsewhere. What if I'm electing late because I wasn't eligible before? In my specific case, I was a visa holder, couldn't elect S Corp, and became a green card holder in the middle of the year. But my LLC was formed last year and has been operating all this year. Can I backdate? Ooh, that's a great question. I frankly don't know the answer. My hunch is that if you are considered an eligible owner for the period that you're electing, there's an opportunity, but I would consult a tax advisor. It gets a little bit tricky with resident status. And I'm frankly not sure with timing, but it sounds like there could be an opportunity. It just may be when it can be effective. Susie's asking, S Corp must have payroll for owner and staff members. What about 1099s? So if you're the owner, and like you're going to take money out of the business because that's your source of income, then you as the owner do need to be on formal payroll. Certain states have different roles for who's considered an employee versus 1099 for other people. So under an S Corp, you can pay 1099 contractors, no problem. It's no issue whatsoever. You just have to consider, is this person truly a contractor based on my state labor laws, or do they need to be an employee? In either instance, under an S Corp, you can have employees other than yourself. You can have 1099 contractors. Again, just consider, I'm in California where we've got very specific rules on paying people as contractors. It's not readily available, which is why more people are forming LLCs. But yeah, you can do it. You can pay people as 1099s or regular employees. Lindsay's been waiting to hear back from the IRS about S Corp election submitted in April. Haven't made quarterly payments. So the IRS is going to take a long time to give you that confirmation letter. Typically, if you feel confident in how you filled out the form, you can assume that you're going to be treated as an S Corp when you submit it while you wait, which means you can get all these processes in place. If you haven't paid quarterly estimates, any payment's better than none. So don't worry so much about missing the deadlines. Just make it up at the next one. Any amount, any payment is truly better than none. It's reducing the risk of underpayment penalties and interest. There are other factors to determine whether or not you're even subject to penalties and interest. So it's very nuanced. Any payment's better than none. It's completely normal to still be waiting if you submitted it in April. So just keep an eye out. In the instance that it gets rejected, they'll tell you why, and you would just resubmit with the same information, same effective date. So you can continue assuming that you are going to be treated as an S Corp. Would S Corp election make sense only when income before distribution wages is greater than a certain number, that there's enough left to make? Okay, so this is a question about when, what threshold of earnings does it make sense to make an S Corp? 60,000 of profit is our gauge to start having the conversation, where when you run a reasonable salary at $60,000 of profit, that savings in the salary and self-employment tax could be more than what collective's membership costs. So does it only make sense? It depends on what your motivator is. Like if you want savings, then it may not make sense until your profit's over this particular threshold. If you like the idea of setting a foundation for your future home loan, there's no rule against profit and having an S Corp. So maybe the win for you is building a history of, salary pay stubs. You can still do an S Corp with lower profit. You do just want to make sure that there is cash flow to run payroll though. Alejandro, does Collective specialize in psychotherapist sole proprietor? So we do support a lot of mental health professionals, medical professionals, but there is nuance here. Depends on where you live, your state, and like the jurisdiction that your license was issued. In some states, they have, and somebody mentioned this already, what's called a professional LLC or professional corporation. Some states require you to have this special type of designation when you go to form a legal entity because you're operating under a state issued license. So Alejandro, for you, depending on where you live, you may be subject to this special legal structure underneath. If it is a PLLC, unfortunately, Collective can't form PLLCs in-house right now. So if you want to get in touch, we have a referral to do PLLC formation. And then if S Corp is still something you want to consider, we may be able to step in and take it from there. If you live in a state, like I'm in California, we don't have PLLCs, we have professional corporations. So if you're in California, unfortunately, we can't help with corporations yet. That's not to say we might not have referrals or resources for you. So in either instance, feel free to get in touch and maybe we can point you in the right direction. Malik, can I still convert LLC to S Corp? Yes. If it's been in place, there's still time. Highly encourage scanning this QR code to book time with one of our advisors before June 30th. So, potentially you can start Collective for free and we'll do all the, backdating to January 1st. So yes, there's still time. Got 1 minute left. Lavetta, your question is the last one we're going to do. Assume you would have to go back and amend taxes if retro is granted. Is that cost effective or should you just go forward? Would LLC taxes already paid be applied? It depends on the solution you find to tackle all of that. So Collective, we can't go back 3 years. We go back to the current tax year because the compliance catch up is time consuming. It depends on what you have. If it's a box of receipts versus a QuickBooks account you never updated. So you would probably have to quote out, what is it going to cost me? to get to a place where I have clean data to put on a business tax return. If you're a bookkeeper and you can handle it, like maybe you DIY it, maybe that 6 hours of one-time work is worth it to you. And then maybe you just, you could do TurboTax, or you pay a CPA to help you file those S Corp returns and amend your personal returns, assuming that the savings potential that you get out of that is more than that cost to do the extra work, and frankly worth the effort for you, then it could be advantageous. Most often we see that it's not, because it's so cumbersome. And so, at Collective, we just go forward. The second piece of your question, would LLC taxes already paid be applied? Yes. So, well, it depends. When you make estimated tax payments, you're applying it to your personal tax bill. So those personal tax bill payments would still be applied to that tax year that they were originally paid for. Some states have like an LLC level, state level fee that may be adjusted, where you have to consider how that changes if you were taxed as an S Corp versus just a single member LLC at the state level. So really, it just depends on the solution you find and the overall savings potential. Where did your profit land? Did you have a high earning salary that maybe, eliminates Social Security savings? So there are a lot of factors to consider. There's no blanket answer. I would say if you didn't have additional W-2 earnings in the past 3 years, and your profit was maybe over 100,000 for each of those years, and I'm bumping it up higher because you're gonna have to consider the catch-up cost. Maybe as an arbitrary flag to say I should explore this more or not, maybe that's a good threshold. There are a lot of questions I didn't get to. We're 15 over. First and foremost, I appreciate the engagement, because sometimes it's crickets and that's awkward for everybody. So thank you for these great questions. We do these webinars often. If I didn't get to your question, please come to the next one. Find me on LinkedIn, follow our socials. We'll get your questions answered. Click this QR code. And if you want to book time with one of our advisors, there's opportunity to have your question answered there. Appreciate you all. Thank you for joining, and we'll see you next time. Bye.